The stablecoin market just crossed $160 billion in total value, with nearly $1 trillion in monthly transactions. That's more volume than most countries' entire economies. You'd think this massive growth means we're building the future of money, right? Wrong. Here's the uncomfortable truth. The more stablecoin products we get, the less progress we're actually making toward a functional global financial system. Today, I'm going to show you why this booming market is actually becoming more fragmented and dangerous every day. Why the competition between USDT, USDC, and newer players like PayPal's PYUSD is making things worse, not better, and what needs to happen to fix this mess before it's too late. The illusion of competition. Let's start with what looks like healthy competition, but is actually a dangerous illusion. Every month, we see new stablecoin announcements promising some revolutionary feature. But here's what's really happening. USDT and USDC control over 90% of the entire market. This isn't competition. It's a duopoly built on completely incompatible systems. Each new stablecoin doesn't improve the ecosystem. Instead, it creates another isolated island. Take PayPal's recent launch of PYUSD on Solana. They're using token extensions that embed compliance features directly into the token. Smart move for PayPal's business, but it creates yet another version of digital dollars that can't talk to other stablecoins. I've spoken with DeFi developers who are frustrated by this fragmentation. One told me it's like having to build a different cash register for every brand of dollar bill. Think about how absurd that sounds, but that's exactly what we're doing in crypto. Circle's strategy of putting USDC on 24 different blockchains might sound like they're making it more accessible, but they're actually creating 24 different non-compatible versions of the same asset. These digital islands are only connected by bridges, and those bridges are disasters waiting to happen. Remember the Ronin bridge hack? Over $600 million stolen in a single attack. Cross-chain bridges have lost over $2.8 billion to hackers, making them the weakest link in our entire ecosystem. The false choice of trust models. This fragmented market forces you into a false choice between two flawed trust models, and I've experienced the problems with both firsthand. First, there's the centralized model, USDC, PYUSD, and similar tokens. Here, you're trusting the company and their auditors. They hold reserves in regulated banks, publish reports, and promise everything is backed one-to-one. Sounds safe? I watched what happened on March 11th, 2023, when Silicon Valley Bank collapsed. USDC had reserves there, and the token immediately lost its dollar peg, dropping to 87 cents. I watched in real time as liquidity vanished and panic spread across every exchange. This wasn't theoretical risk. It was a stark reminder that centralized stablecoins are vulnerable to traditional banking problems, no matter how well audited they claim to be. Then there's the decentralized model, like DAI. Here you trust the code instead of a company. DAI is created by locking up excess crypto collateral in smart contracts that anyone can audit. No banks, no companies, just math and cryptography. But this introduces different risks. What happens when crypto crashes? What if there's a bug in the smart contract? What if price oracles get manipulated? I've sat in MakerDAO governance calls where these risks get debated endlessly. Here's the irony. To make DI more stable, MakerDAO started backing it with centralized stablecoins like USDC. Today, over 60% of DAI's backing comes from USDC. So much for decentralization. They've just recreated the same custodial risks they were trying to eliminate. Real-world problems nobody talks about. This fragmentation creates real problems that hurt real people every day. Let me give you some examples from my own experience. I recently helped a friend move USDC from Ethereum to Polygon. What should have been a simple transfer became a multi-step process involving gas fees on both chains, bridge transactions, and constant anxiety about whether the bridge would actually work. We paid what I call the liquidity tax, extra fees, and security risks just to move the same asset between different blockchains. But the bigger problem is what I call the last mile issue. Try explaining to your grandmother how to convert USDT back to actual dollars she can spend. The on-ramp and off-ramp process is still complicated, expensive, and technical. I spoke with migrant workers in Dubai who send money home to the Philippines. Despite high fees from traditional services, they still prefer Western Union over crypto. One worker told me, "I tried using USDT once, but my mother couldn't figure out how to convert it to pesos without my help." This is the reality that crypto enthusiasts ignore. We're building products for ourselves, not for the billions of people who need better money transfer systems. The unsustainable trajectory, here's where things get dangerous. This fragmentation isn't just inefficient, it's creating systemic risks that threaten the entire ecosystem. Every new stablecoin divides liquidity further. Developers have to integrate multiple tokens instead of focusing on building better applications. Users face confusion about which token to use where. Regulators see a chaotic landscape that's impossible to govern effectively. We're not building a better financial system. We're building a more complicated version of the same broken system we already have, complete with all the same risks and inefficiencies. The current trajectory is unsustainable. We need a fundamental shift from competing products to compatible protocols. The path forward, interoperability as the solution. So what's the solution? We need to shift our focus from creating more stablecoin products to building better stablecoin protocols that work together. The future isn't about having the best stablecoin, it's about having stablecoins that communicate seamlessly with each other. Projects like the Universal Digital Asset Access Protocol and the Interledger Protocol are working on exactly this problem, creating standardized ways for different stablecoins to interact without vulnerable bridges. We need regulatory frameworks that encourage interoperability instead of reinforcing silos. The European Union's MiCA regulation includes provisions for technical standards that could push the industry toward compatibility. The US should follow with thoughtful regulation that prioritizes open access and interoperability. I'm starting to see encouraging signs. Industry working groups focused on stablecoin standards are forming. Major DeFi protocols are implementing unified liquidity pools that treat different stablecoins as interchangeable within certain parameters. But this won't happen automatically. It requires intentional collaboration between issuers, developers, and regulators. The call to action as users and builders in this space, we need to demand more than just new stablecoin products. We should advocate for an ecosystem where digital dollars flow as freely as information on the internet without artificial barriers or unnecessary risks. The true measure of progress in stablecoins isn't the number of products available, it's how seamlessly they work together to create a more accessible, efficient, and resilient financial system for everyone. We have the technology to build this interoperable future. What we need now is the will to prioritize collaboration over competition, standards over silos, and real-world utility over marketing hype. The stablecoin paradox is solvable, but only if we're willing to break down the walled gardens we've built and start working together. The future of digital money depends on it. Conclusion: if you found this analysis valuable, subscribe for more deep dives into the crypto trends that actually matter. And let me know in the comments, do you think the stablecoin market will consolidate around interoperability standards? Or are we doomed to endless fragmentation? Remember, this is educational content only, not financial advice. Always do your own research before making any investment decisions in the volatile cryptocurrency space.